Now that is more dovish than the most dovish expectations in the market. Nobody we polled told us that there will be no rise in the reverse repo. As well, nobody told us that there will be a fall in the inflation projection for next year. The RBI's previous forecast was 5% and 5% Q1 and Q2. They've actually brought it down to 4.9 and 5%. And of course, the subsequent new forecasts, and they have come in at an amazingly low 4% and I think 4.3 if I'm not mistaken.
4% for Q3, 4.2% for Q4 and 4.5% for the full fiscal.
For the full fiscal. That 4.5 is going to take the market's breath away. At this point in time, it is celebration all over. The bond markets are jubilant, at least at this point in time. People are sitting very light and therefore you would have seen a goodish amount of buying, and you've seen the equity markets also jump in joy, especially the Nifty bank and the entire set of bank stocks, because this kind of a rally in bonds is going to bode a lot of mark-to-market gains or at least avoidance of losses for a lot of the banks, and therefore this is absolutely green all over. You can look at the NBFC stocks, you can look at housing finance stocks. There is just jubilation everywhere because there is not even a suggestion of anything hawkishness. The word H as itself doesn't exist. It's such a dovish policy. Inflation forecast coming down, no touching the reverse repo. And perhaps the only shade of hawkishness would be that there is a 5-1 vote on the accommodative stance. It is not a 6-all. Yeah. So I would assume it would be Dr. Jayant Verma, going by his previous utterances, that he would want a neutral stance. And one can see his point of view. You're not going to cut. You're only going to hike from here. Yeah. So why should you be accommodative? Why not neutral? Could have been his stance. But otherwise, extremely dovish. Not much mention as to how they'll manage the borrowing program.
Yes, no mention of the word HTM, nothing at all on GSAP, of course, was not expected, but they continue to maintain that VRRR, that is variable reverse rate repo auctions, will continue to be the way forward. On growth, it is actually slightly more conservative than what the NSO had factored in. So RBI says FY23 growth will come in at is expected at 7.8% versus NSO's expectation of 8 to 8.5%. So it's slightly lower.
It is not so much NSO, it's more the economic survey.
Economic survey,
yeah,
sorry.
So I take your point. But the government saying that the nominal growth will be 11.1 gave an impression that they have not gone with 8 to 8.5.
And they've revised downwards the growth projection for the second quarter of the fiscal from 7.8 that they had said in the previous policy to about 7% now. For Q1, it's been retained at 7.2, 4.3 for the third quarter, and 4.5 for the fourth quarter. But like you said, more was expected perhaps on the liquidity management front, and we haven't heard much on that from the governor other than assurances that there will be fine-tuning operations. They will continue with VRRR, but nothing much for the markets to take beyond that.
Absolutely. So stance and policy extremely dovish. On liquidity, a total absence of anything with respect to borrowing, and that is entirely on expected lines. They would watch the US CPI and a whole host of events in the next 50 days before the first borrowing program starts or before the next policy, and they will have plenty of time to give the market any help they need in terms of helping with the borrowing program. So actually on expected lines when it comes to liquidity, why waste your bullets? But on the policy front, I would think that this is way more dovish than what our respondents told us in the poll, both on the reverse repo front and in terms of their inflation forecast. 4.5, no. There were almost everyone I spoke with are standing at 5% or a little above 5% for next year's inflation. So 4.5 is going to, kind of surprise the market at the moment pleasantly, but there will always be accusations that the Reserve Bank is probably falling behind the curve. But let's ask the experts. They are with us now. Abheek Barua, the economist from HDFC Bank, Amandeep Chopra, the fixed income expert from UTI Mutual Fund, Rajiv Anand, the Deputy Managing Director, Axis Bank, Jayesh Mehta, Country Head, Bank of America, Upasana Bharadwaj, the economist from Kotak Bank, Ashwini Kumar Tiwari, the banker, Managing Director from State Bank of India. In a bit, we will also get a stock market expert. I think it would be Aditya Narayan. Yeah. But gentlemen and lady, welcome to the show. Abheek, to start with you, Would you accuse the governor of being behind the curve, would be more dovish than you thought?
No, not really. I mean, this was very much on our expected lines. We were not one of the respondents to your survey,
Okay.
but our forecast was for an unchanged reverse repo rate, given the fact that an effective, and which he sort of referred to, 50 basis point increase has been achieved at the short end, and given the sort of myriad uncertainties around Omicron and so forth, they wouldn't do anything. I think for any kind of change in stance or a significant change in the communique, you would need to see durable, broad-based recovery, which he took pains to emphasize, and that's is still not there. I mean, you have a number of sectors which are lagging behind. Some sectors have picked up. They've clearly decoupled from the Western central banks, and I think the Fed is actually doing the job for us, because our 10-year bond yields kind of tend to respond to what the Fed is doing. I kind of agree with you that the inflation numbers are a tad optimistic, but I think more than the levels of inflation, it is really the trajectory of inflation, which is sort of a downward sloping glide path, which is what this policy, which is, I think, a very forward-looking policy, perhaps excessively forward-looking from some perspectives, is, it's looking at the glide path, saying that, well, we are getting there along a steady path.
Okay.
And so based on that, it doesn't make sense, given the lags in policy effect, to do much at this stage.
Abheek, I'll just come back to...
The growth numbers are conservative. The big thing, I think, and I think this has implications for growth, because there are fears of crowding out rather than crowding in, and the crowding out coming from interest rates is how this massive government borrowing program is going to be managed, on which there was absolutely no indication. I think the market, despite its temporary euphoria, will go back to fretting about how much support the RBI will provide the government in pushing through this unexpectedly large borrowing program.
Fair point. Abheek, you'll have to let me get the others also give their comments. We will come back to you. I take your point that his communique has not been changed at all. It continues to remain to revive and sustain economic growth. Even that phrase has not been changed by the governor, at least the way he read out. We still don't have the official statement in black and white, but he seemed to absolutely read out last year's stance entirely. The communique changed only in terms of an inclusion of a Lata Mangeshkar quote. Normally we have only Mahatma Gandhi quotes, but this time Aaj Fir Jeene Ki Tamanna Hai has also made its, the Immortal Guide song also made its presence. But let me get the banker in. That's the place where the action is. We have Mr. Ashwini Kumar and Rajiv Anand with us. Mr. Kumar, Mr. Tiwari, you go first. What do you take from this? Will you be hiking, or will you postpone any decision to hike rates right now, deposits or lending?
Our decisions are driven largely by the demand and supply, and as to how we see deposits coming in. As you are aware, we did increase one maturity of 1 to 2 year by 10 basis points. And on the bulk rates also, we have increased, because wherever we see that there is a supply from the deposit side, we would take that decision. However, if the RBI changed any rates or this thing, definitely the market would have reacted and we would have also reacted. As of now, I don't think we are going to react to this policy. It is on expected lines. There is no change. And if we see there is a need for increasing in a particular maturity, we might do that, as we have done earlier. So nothing, I mean, we don't see any trigger from this policy at this for the time.
But Mr. Rajiv Anand, what do you think? I mean, HTM extension is something that the markets was expecting. That hasn't come.